Hi, everyone. In this session, I'm going to be talking about trading through volatile markets. And I think it doesn't matter what market commentary you listen to or read about, somewhere in the text at this moment in time will be the word volatile or volatility. It's with us. I think it's going to be with us to stay for quite a while. And in actual fact, if you look at this survey here done by JP Morgan, surveying a bunch of institutional traders, one of the questions was around market structure. What will be your greatest daily trading challenge in 2023? And as you can see there, 46% of people mentioned or cited volatile markets. And that actually usurped liquidity as being the key factor in 2022 survey. They do actually go hand in hand, liquidity and volatility, to be honest, but a resounding vote in favor of volatility as being one of the big problems for the year. So if we're going to have volatile markets, one of the things I always look at is understanding what does it actually mean? What are the characteristics of volatility within any of the financial markets that we trade in? Well, this is not an exhaustive list. This is just some of the things that I'd like to point out. Generally, you'll find the speed and extent of the moves is much, much sharper and bigger. It is a factor of liquidity. It is a big factor of the uncertainty that's in markets. So markets tend to react in a slightly more random and aggressive manner, and the lack of liquidity tends to extend some of those moves. That uncertainty also brings sharp reversals, and these are some of the hardest things for us to trade in. It's very, very, for me, the traders, the less experienced traders get far too emotionally attached to their trades. So when we get some of these sharp reversals, that's when some of the real pain can come in, and that's where discipline really is needed. So those sharp reversals, very characteristic of volatile markets, and we need to be wary of them. You will also get random reactions to some headlines. Part of our job and our role as traders is to interpret headlines, maybe plan ahead to some of the scheduled headlines, look at response to the market. Is that headline discounted? Anything like that. But even having done that homework, we can find that the reaction after any announcement, whether it be a data release or, at the moment, some of these central bank releases and policy shifts, the reaction just isn't what we interpreted. And that's very, very characteristic of volatility. And, just one thing to add there around gaps, particularly in stock markets where we do have closes in markets, but also in FX, where the market does close over the weekend. Quite often, if there's a weekend announcement or whatever, you will get a gap into the opening of Asia market on a Monday morning after the close in New York on the Friday evening, and that gap will actually be bigger in volatile markets. So we need to be careful of those as well. Now, having acknowledged this volatility, one of the things we could do is hide a little bit from it. We can see our calendars, we can see scheduled headlines, etc. And as we see here, the early part of February, we had some FOMC activity and we had payroll numbers, and all of a sudden real volatility came into the market. You see those sharp extended moves. You saw a big reversal up the top, and what ended up being a capitulation all the way down to the 3rd of February low. So we could actually anticipate that and say, I don't want to be trading in that type of environment. And that's valid if it maybe doesn't suit your trading style. But we can go to the other end of the spectrum and say, well, we could only trade during quiet times. But even then, as we see here in oil, we could be steadily trading oil along that fairly flat line, looking at fairly tight ranges intraday, and then all of a sudden you get an unscheduled headline. And in this instance, it was the UAE talking about leaving OPEC. Bang, the market falls very, very sharply, but then you get that sharp reversal as 30 minutes later, any rumors were denied. So all of a sudden you've got volatility in there in what you thought was a quiet market. So really you can't get away from it. And what we have to do as traders, and bearing in mind, if we put our feet forward, our best foot forward to trade in a market, we are taking on risk. And risk also involves taking losses on a market moving against you. So really what we have to do is accept the inevitable consequence of trading in volatile markets and adjust our trading accordingly. If we understand the characteristics, then what can we do about it to be able to survive these volatile markets, and not just survive, actually end up winning and taking money out of the market? Well, for me, the first things we actually have just spoken about is to understand that there are opportunities out there and understand the dangers that lie within these volatile markets. So the first thing we can do, as much as we can, is plan ahead. We can look at our calendar. We can look at these potential volatile times. We can't do much about unscheduled releases apart from being very, very disciplined as soon as we acknowledge them coming into the market. And sometimes it's a bit of a toss of a coin if you already have risk on as to whether they can impact your P&L in a positive or negative manner. So be it. We have to deal with that. But as much as we can, let's plan ahead, see where we feel there could be some volatile times, generally around these releases, and try and anticipate, do our homework, so that we actually know what should be coming down the pipe. And then we have to accept that even if things come down the pipe as we expect them, the reaction may be a bit more random than normal. So we have to be very, very alert around these releases. And in actual fact, that should be the case throughout all of our trading when we're in this heightened period of volatility. One of the key things that we should be doing is looking at our risk. If we know there's volatility in the market, we know generally we put risk on. One of the first things, if not the first thing we should be doing, is looking at where we think this trade is wrong, where the market is telling us if it goes through a certain level, my idea is gone. That generally comes through historic data from the charts telling us that we had good support and resistance lines at certain levels, some of those being stronger than others. And we should use all of that information to find out where, if markets go certain directions, our trade idea is wrong. That's where we need to be putting our stop loss somewhere just above or below those resistance and support lines. And if we go through them and get stopped out, as we know we will, because markets will take us out at times, that's just the nature of the beast. We need to make sure that we've established is at the correct level, and if taken out, it's affordable to us. And sometimes in volatile markets, these stop losses are forced a bit further away because the moves are extended a bit further. If that is the case, and we can't afford to have that much risk on at that level that we enter, and our stop loss kicks and it's not affordable to us, we don't move the stop loss closer to the market. We actually lower the amount of risk so that it becomes affordable. And so what we're actually doing is adjusting to those more volatile times, and we're being smart about the way we trade. One other key thing I would ask is, in volatile times, please don't chase every headline because of the randomness of some of the responses to those headlines. Now, there's another little analogy here, and again, this is part of us understanding why things happen. And very briefly, in quiet, normal, trending markets, we get this nice casual, plenty of entry levels. We've got lots of traders ambling through a very large yellow door, plenty of liquidity, no one's panicking, etc. But what happens is more and more people find access to this trade. The trade becomes heavily populated, and then when some of these random responses come through, everybody tries to get out of the door at the same time. But unfortunately, liquidity comes less, the market's moving quicker, and as you see on that right-hand side, the traders aren't ambling anymore. They're actually in a sprint position. They're trying to get through a much, much smaller door. That's why markets get squeezed. That's why they move a lot faster, and certainly on some of these sharp reversals. So if we understand that concept, it should tell us how much more disciplined and alert we have to be as well in these markets. And actually, again, one of the key things here in volatile markets, unless you're very experienced, one of the hardest things is being over leveraged. So I would really, really look at making sure that we align the amount of risk we have in the market, not just to our trade idea and our strength of opinion on that trade idea, but to market conditions. And in volatile conditions, we probably should be reducing the amount of risk we put into the market. We can still have plenty of opportunity to make money because we have these extended moves. And if we get on those, we don't have to have so much risk on to make as much money as we may be looking to make. So it's not a negative factor. It's actually being smart about the way we trade. One other key thing is this emotional attachment that I mentioned. In short-term markets where there's a trend available, people get emotionally attached. They think this will go on forever. They think they can just keep riding that trend. They may be in and out of that on a daily basis, but they're continually playing the same trade. When you get to some of these pivotal points, and we certainly are seeing them, when we've probably got one this Friday with payrolls, and any of these, particularly the Fed releases, the major G7 economies, any of these policy shifts, we have potential pivotal points. We have possibilities of the big door, little door analogy. So in these instances, we have to make sure we're not emotionally attached to these trades and where they're sharp and disciplined to get out of them when we see this pivot maybe go the other way. This is a blind spot for people. We actually start interpreting news in a different way, always with rose-tinted glasses, and we don't actually see when some of these markets are going to shift. And what we also tend to do is unnecessarily move our goals from a profitable side. We get greedy, and we also shift our stop losses. That, again, is just fear. Two of the biggest market characteristics that drive our behaviors, fear and greed. And that's what makes us move our orders. And actually, in the end, we either cost ourselves more money or we lose the opportunity to take a decent profit. So be very, very disciplined. Lose this emotional attachment to trade. You've got to be pretty cold about this in volatile markets. Stay true to your own trading style, but occasionally you're going to have to rip up the playbook and just get out of something, because often the first cut is the cheapest. So be careful out there in volatile times, but don't be afraid of it. Respect that market. Just adjust the way you trade according to the market conditions.